Browne. Welcome to MFB News. Hope everybody is absolutely fantastic. You had a really good week and all that kind of stuff, mainly dodging rain showers, I'd imagine, a bit like myself. Now, in terms of what we've got for you this week, usual roundup on what's been happening with swap rates and lender pricing changes. We're going to have a little bit of a look at a couple of pieces of lending criteria change that we've seen in the last week and kind of discuss where they sit in the market. We're going to talk about the predictions for what's going to be happening with base rate over the rest of this year and also actually next year as well, see what the economists in the city have to say about that. And then finally, we're going to have a bit of a discussion about whether you're a selfie or not, i.e. you self-manage your buy-to-lets and how that lands with tenants. Okay, so getting stuck straight in with swap rates this week, and actually stuck probably is quite the right word. So it looks like things just aren't moving, and actually when we think about what's going on and the kind of predictions for base rate and all that kind of stuff, it's no great surprises. So 2-year swaps currently at 3.68, 1 month ago 3.66, and 1 year ago 3.69. So basically in the passage of a whole year, we've actually made no progress. 5 years 3.72, 1 month ago 3.73, and 1 year ago 3.71. So once again, year on year, we're basically in exactly the same position. So what does this mean in terms of lender pricing changes? It means that their cost of funds hasn't really changed. So any pricing changes we're seeing with lenders is really just sort of coming from them tweaking their own pricing set. Maybe they kind of added on some margins because they're a bit busy. They've removed some of that margin, either going to make less money because they're looking to drive up business and all the kind of stuff that goes into pricing. But fundamentally, there's no really big reason why lenders should be changing their rates at the moment. Now, that's not to say we haven't seen any changes in the last week. We have. As you will recall, swap rates kind of went up a bit, then they came down a bit, and now they've kind of gone back up again. So we're kind of bouncing around sort of 3.6, 3.7 on 5-year swaps. So what some lenders are doing is reacting to all of these changes. So some of them have a bit of a bigger lag. So as an example, to illustrate what I mean by this, in the last week, fleet mortgages have put their rates down by up to 0.15%. However, Clydesdale Bank have put their rates up. So because the swap rate movements are very, very small, but they're happening quite quickly, what we're going to see is different lenders having a different turnaround time, essentially. So to continue on with that for a moment, and what we've seen with lender pricing changes, so as I mentioned, fleet rates down by up to 0.15%. I'm going to talk a bit about the lenders this week. There's only 3 of them, so we can just to afford a little bit of time there. So fleet mortgages are a specialist lender. Very, very good at service. Their service is great. Their pricing is competitive. They're funded by a Starling Bank. For those of you who are kind of more techie, you would know these guys as being people who do a really cool little banking app like a Monzo or a Revolut, that kind of thing. So they have access to savers' money. So these guys aren't wholly exposed to the swap markets, but they will still be leaning on them to some extent. So pricing very good. Limited company criteria. I would sort of put them as a mid-specialist lender. I'm going to create another category of lender now. So they're not like a high street lender who dabbles in the more specialist space. So by that, what I mean is BM Solutions, or a really, really vanilla lender on the high street who do a bit of specialist lending in terms of the fact they limit to limited companies now. Fleet are kind of more kind of adventurous with their lending policy than these guys, but they're certainly not a paragon bank either. So they sit somewhere in between. So these guys are really good for getting a competitive rate if you're looking to do a mortgage for a limited company, if you've got someone with a large portfolio of property in the background. They can do your smaller HMOs, multi-units, that kind of stuff as well. But the actual borrower profile has to be very, very clean. So limited companies, it's a straightforward SPV, no layering, want personal guarantees from basically all of the shareholders and directors. And they don't do things like day one remortgages, so it's a very, very standard proposition, but the pricing is very, very good if you can get at it. Clydesdale have put their rates up by around 0.2%. Clydesdale are kind of the antithesis of Fleet in some regards. They're very much a high street lender. They're not big on buy-to-let by any means. They tend to run an overall affordability calculation. So what is your total income coming in and how much are all of your commitments, including your buy-to-lets? This works really well for someone who's got a good salary, relatively small home mortgage and one buy-to-let. What it doesn't work well for is people with large portfolios. So that's Clydesdale. And then lastly, we've seen Aldermore bring their rates down by up to 0.2%. Now, Aldermore specialist lender. Been around, probably one of the first kind of challenger banks that came out after the credit crisis. Very, very good. Some really nice pieces of lending criteria. For example, they can lend to trading companies. Don't mind how many properties you've got in the background. Day one remortgages, we'll come on to that in a moment. And lots of other great stuff in there as well, but definitely more of a challenger bank. So really, in terms of lender pricing in the last week, it's just 3 lenders changing their rates. Why is it so few? As I mentioned, their cost of funds hasn't really changed. I'm sure things will kind of move by this time next week, and we will be keeping you posted. Okie dokes, now moving on to lending criteria changes, and there's 2 pieces of criteria change that I want to talk about with you this week. So the first one is coming back to our friends at Aldermore that we just mentioned. They have gone into day one remortgages. Now what's exciting about this is they can lend against open market value from day one. So essentially I can go to auction, or whatever way I choose to buy a property, it doesn't have to be an auction. I can buy a property for £100,000. I get it for a really good bargain because for some reason no one else wanted to buy that property. It's really worth 130, so I could buy on a bridging loan and then remortgage to Aldermore the very next day based on a value of £130,000. If I borrow 75% loan to value of £130,000, I'm basically getting my cash back out. So this is why people like day one remortgages at open market value. Now there are a few kind of rules they have that sit around your day one remortgages at OMV, open market value. The first one is that the property must be bought at an arm's length transaction. So what that means is that my dad couldn't sell me a property which is worth £200,000 for £100,000 and then next day me say to Aldermore, right, can you now lend against this? It's worth £200,000, because the set transaction that went through when the property became mine was not at open market value. So the initial acquisition of the property must have been done at arm's length, and there can't be a relationship between myself and the seller, i.e. arm's length. There is no relationship between the person buying and selling the property. They're also saying that at the point the valuer goes out, the property has to be habitable. So if you're buying a bit of a project that you're going to turn around really quick, you've stripped out the kitchen, you're trying to get your ducks in a row and get your mortgage application sorted so you can move on to the mortgage very, very quickly and probably avoid bridging terms for too long. The point at which the valuer goes out, the property has to be habitable, i.e. that ripped out kitchen needs to have gone back in before you can actually have the valuer go out. They're going to be a bit kind of particular about who the solicitors are acting for them on this. And the other thing they go on to say, which I found really interesting, was that brokers should provide a TR1 form or a disposition form in Scotland with the initial application. So what this is basically doing is acknowledging that there is huge delays with land registry in terms of the TR1s. So actually, rather than not being able to deal with this challenge, if you just send in the TR1 to demonstrate you've actually acquired the property, this saves the lender doing a land registry search and saying, well, hang on a minute, Jeni doesn't even own this property, so why is she coming to us for a remortgage? So more and more lenders are actually kind of moving towards this because of the delays at land registry. They're trying to adapt and find ways that they can work around this. Now, just incidentally, if you are having a delay with land registry in terms of either your TR1 or also if you're creating you're splitting a property into leaseholds, for example, but anything that's kind of a delay, if you ask your broker to send you an email explaining that actually this delay is meaning that you're unable to progress with the mortgage and therefore it's causing you financial disadvantage, then actually land registry do tend to act very, very quickly. So just worth being aware of that. So there you go. So that's Aldermore's new criteria, hot off the press. The other thing we've seen in the last week is that YBS, Yorkshire Building Society, have, they've always been a commercial lender. So YBS are a commercial lender who does a bit of buy-to-let. So they do limited company buy-to-lets, larger HMOs, multi-unit blocks. For anything really straightforward, they have their sister lender who's called Mortgages, and these guys are picking up lending to individuals on straightforward properties. But YBS, so like I say, have always been in this commercial, semi-commercial space, but what they've done is they've started splitting out their products. So they're now bringing in better rates at 55%, 65% and 75% loan to value products. So at 55% as an example, rates start from 5.5% with a 2% fee. And for those of you who have been looking for semi-commercial, commercial pricing at the moment, you'll know that's very, very good. So well done to YBS for kind of looking to be more competitive in a very underserved part of the market. Now also just to say that they're also including within their semi-commercial product range smaller HMOs, so up to 6 beds, and also holiday lets as well. So they've really kind of cleaned up their product set and tried to make it more competitive, which actually, you know, who wouldn't be very, very happy about that. Okay, so next week we've got the ONS inflation data, and then we've got an MPC meeting to look forward to as well. And I know that there are people who are kind of holding out, hoping that we're going to see a base rate reduction next week, mainly on the back of the fact that the country's productivity, our GDP, is looking pretty light, and therefore they're going to try and boost the economy by dropping interest rates. That's the kind of thought process there, and it's not a bad thought process by any means, but actually what are the people in the city saying? So interest rate cuts are unlikely to take place this year, and this is according to some forecasters. Now, city analysts are split on where they're going to settle, given the UK's battle against high inflation and low growth. So what they're going on to say is that markets and economists widely expect the bank to hold interest rates at 4%, with further holding votes expected to come in November and mid-December as well. So no further base rate reductions this year, guys. Now, where the split seems to actually come more than what's going to happen this year is next year, on whether rate cuts are going to come at all, with an increasing number of economists revising down the number of cuts they're expecting to make in the nearer term. And there's various kind of economists who have been quoted in this particular article, and I'll just give you a bit of kind of an excerpt of what they're saying. So Pantheon Macroeconomics have long predicted that interest rates will remain at 4% for the next year, given the bank's difficulty in bringing down inflation to its target of 2%. HSBC are also predicting rates are going to be kept on hold at the bank's next 4 meetings, while Deutsche Bank now believe interest rate cuts will only be in December rather than November. Capital Economics believe, however, that interest rates will fall to 3%, though its prediction could be swayed by the reading on the minutes and the split in the MPC. So more to follow on that. So essentially what we're hearing here is that actually the prediction for base rate going into 2026 is very much that some are saying it probably won't come down at all. Some are saying it might come down maybe once or twice, but it's going to be much lower than people had anticipated. Now, for those of you who kind of can put the connection together there with fixed rates, you will see that actually, if we look at, for example, a 5-year fixed rate, the average cost of base rate over 5 years will be higher than previously thought, because the people are revising down their forecast about how quickly and how far base rate is going to come down. Therefore, that impacts swap rates, and that's why we're seeing, at least in part, the reason our things are staying a little bit sticky. So we will see what happens next week at the meeting. We'll have the inflation data probably by the time I record this, although saying that it is 6:30 in the morning, so we might be a bit early. But it'll be interesting to see how the markets react to that inflation data. Hopefully things have come down a bit, but I'm not feeling overly optimistic, if I'm brutally honest. But really, I think in terms of mortgage borrowers, the things you really need to understand here is how this all impacts you. And really the kind of purpose of me telling you about this is that for those of you who are either holding out for a base rate reduction next week before making a decision, that's what the experts, the economists are saying. Also looking forward into next year, just being worth kind of aware that whereas people were saying base rate will be at 3% by the end of 2026, looking incredibly unlikely now. And therefore we're not expecting any major movements on fixed rates either. So I think the overarching message in a nutshell is we kind of are where we are for the time being. Okay, now I read an article which I found really interesting, which is talking about tenants' experience of dealing with landlords who self-manage versus those who use a letting agent. Now, for transparency, I use a letting agent because, quite frankly, if my tenants had something needed getting fixed, it would never get done if I was in charge of it. So I'm quite happy to pay letting agent fees to let someone else do it. But you pay them a lot, Where we are, the going rate is sort of like 13 to 15%. So I know that people are much better negotiators than I am, and also some areas command lower management fees. But fundamentally, around this part of the world at least, we're paying quite high rates. So we do expect a good service for our tenants, actually, for that kind of money. The other thing just to note is that what people are kind of mooting is that actually with the Renters' Rights Bill coming into play, that first of all, more landlords are going to move towards using managing agents because of the complexities, also because letting agents or managing agents are going to have proper qualifications to continue to rent properties out or manage properties. So that should drive up that side of things. However, for now, the research, which was amongst thousands of verified tenant reviews submitted between 2017 and 2024 to the Marks Out of Tenancy renter feedback platform shows that independent landlords consistently receive higher ratings than letting agents across key areas of the rental experience. So according to the data, self-managed landlords received an average tenant satisfaction score of 2.48 out of 5, which, you know, for those eagle-eyed amongst you is still less than 50%, but actually, you know, maybe the tenants are kind of driving a hard bargain there. But letting agents scored just 2.32%, and these figures reflect real-world experiences of renters and provide insight into where trust and performance are being earned or lost within the private rental sector. And I think that's kind of a really key point here. Now, one tenant on the platform reviewing a letting experience in Bristol commented, "When I dealt directly with the landlord, things got done quickly and without stress, but through the letting agent, even basic repair works took weeks and emails went unanswered." Now, the article that I read goes on to talk about the importance of deposit protection. So while independent landlords scored higher overall for tenant satisfaction, surprisingly, letting agents led the way on deposit protection, with 75.1% of deposits fully safeguarded, surpassing the 66.8% rate recorded among self-managed landlords. And this indicates that letting agents may have a stronger awareness of their legal obligations when it comes to deposit protections. So there you go. So what we can see is that actually probably letting agents are better at sticking to the rules, but self-managed landlords are actually much better at looking after their tenants. And I think what we can take away from this is the reality is that if the tenants are only giving the highest scoring responders, the self-managed landlords, less than 50% on marks, and the letting agents even less, one could argue that maybe there is some room for improvement in the way that some landlords and letting agents are looking after our tenants. And there you go, another week goes by in the exciting world of mortgages and the private rental sector. If you have any questions, you know where we are, 0345 345 6788, or have a look at our website. As an aside, I'm planning our next webinar and I wanted to get your thoughts. I'm thinking about enlisting the help of a tax advisor and a lawyer to come and talk to you all about estate planning. Let me know what you think. Would this be of interest, or can you think of something better to talk about? Be interested to hear your views. Obviously, these webinars are designed exclusively for your benefit, so actually it'd be really good to hear what's on your mind and who we can bring to speak to you, which experts, obviously absolutely for free, to share with you some advice which may be useful. So do let us know in the comments below. See you next week.